Any business is looking to get its own competitive advantage, and there are many analysis tools that are used in business to, sort of learn their competitive positioning, to learn how to evaluate options that are available to them, and ultimately, how do they make the right decisions based on their business strategy. Most of these tools end up in the same place. They kind of cover similar territory. I'm going to go through a couple of them with you now at a very high level. I'll have the opportunity to distribute specifics should we need to go in that direction. But I'm just going to give you some of the things that you'll be exposed to over the course of your business career. So one tool that's fairly popular, it's the BCG matrix based on the Boston Consulting Group. It's a growth share matrix. It's a corporate planning tool, and it's used to portray a firm's brand portfolio, or how a business unit, how different business units perform relative to their market share and their speed of market growth. Now, these different categories, I'll go through them with you. So a cash cow would be these would be the products that are most profitable brands and are the ones that should be milked to provide as much cash as possible. The cash gained from the cows should be invested into more of the star products to support their further growth. According to the growth share matrix, corporations should not invest into the cash cows to induce growth, but only to support them so they could maintain their current market share. Again, this is not always true. Cash cows are usually large corporations or business units that are capable of innovating new products or processes, which may become new stars. If there would be no support for cash cows, they would not be capable of such innovation such as that. But you have different strategic choices with a cash cow. You can do product development, diversification, divestiture, or retrenchment. Now, a star would be a product that operates in high growth industries and maintains high market share. Stars are both cash generators and cash users. They are the primary units in which the company should invest its money, because stars are expected to become cash cows and generate positive cash flows. Yet not all stars become cash flows. This is especially true in rapidly changing industries where new innovative products can soon be outcompeted by new technological advances. So a star, instead of becoming a cash cow, might become a dog. So your choices here for star products would be things like vertical integration, horizontal integration, market penetration, market development, or new product development. Then you have question marks, which are brands that require much closer consideration. They hold low market share in fast-growing markets, consuming large amounts of cash and incurring losses. It has the potential to gain market share and become a star, which would later become a cash cow. Question marks do not always succeed, and even after large amounts of investments, they struggle to gain market share and eventually become dogs. Therefore, they require close consideration to determine if they are worth investing in or not. Some of your choices here would again be market penetration, market development, product development, or divestiture. And finally, you have the dogs, which hold low market share compared to competitors and operate in a slowly growing market. In general, they are not worth investing in because they generate low or negative cash returns. But this is not always the truth. Some dogs may be profitable for a long period of time. They may provide synergies for other brands or business units, or simply act as a defense to counter competitors' moves. Therefore, it is always important to perform deeper analysis on each brand or business unit to make sure they are not worth investing in or have to be divested, and that would be one of your strategic choices. It would be retrenchment, divestiture, or liquidation. So there's an analysis that would go behind this. Different products or units would be put against this matrix, and that would help executives make decisions about what's the best way to go about making investments against their strategies. A follow-up, I guess something that seemed to improve upon the BCG model was the McKinsey 9-box matrix, which again is a strategic tool that offers an approach to multi-business corporations to basically prioritize investments amongst different units. So that the axis would be industry attractiveness versus the strength of a business unit, and that would determine your units that score high on both of those would be the ones that you would invest the most in. The ones that you would that would score lowest on those would be the ones that you would be less likely to invest in. These two models are very similar. I would say the McKinsey one comes across as being a little more sophisticated because it spreads it out a little more, but they roughly do very similar things. Another tool that companies use is benchmarking. It's a strategic tool used to compare the performance of business processes and products within the best performances of other companies inside and outside the industry. It is really the search for best practices that lead to superior performance. There you have a lot of folks in the quality arena, which we'll get into a later unit, that spend a lot of time studying other companies, whether it be through public information or other means. Benchmarking can absolutely be critical to strategy, to performance of an organization. Then you have the VRIO framework, which is a tool used to analyze a firm's internal resources and capabilities and to find out if they can be a source of sustainable competitive advantage. And it's relatively simple. It's asking questions about the resources or capabilities within the firm in terms of in terms of the products. Are these valuable products? And if the answer is no, then it's a competitive disadvantage. If the answer is yes, then you would ask the next question. Is it something that's rare? Is it something that is costly to imitate? And if the answer could be yes, 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 now you know that the new product or services that you're thinking about are probably more worthwhile investing in. And then you could ask further questions like, is the firm organized to capture the value? And if the answer is yes there, is it prepared to create sustainable competitive advantage? And there are, with all three of these models or four models that I've had so far, there are metrics that are attached to them and more quantitative analysis that would go, which would go with these frameworks, which I will sort of distribute when we get to the project work in this section. Then there's value chain analysis. This is a process where a firm identifies its priorities and support activities that add the most value to the final product, and then analyze these activities to reduce costs or increase differentiation. Basically, VCA represents the internal activities a firm engages in when transforming inputs and outputs. And you can see here there's the industry value chain areas such as raw materials, intermediate goods, manufacturing, marketing, sales, and after-sales service. And then there's the company's value chain within its own manufacturing, which includes inbound logistics, operations, outbound logistics, marketing and sales, and service. And this is all built on the foundation of the firm's infrastructure, its human resource management, its procurement strategies, and its technology. We'll get a little deeper into that when we get into our section on total quality management. But it's an interesting way to analyze a business so that you can kind of see where your strengths and potential challenges are within a firm. SWOT analysis is a fairly popular technique that's used. It's relatively simple. It involves the collection and portrayal of information about internal and external factors which have or may have an impact on the business. It's a framework that allows managers to synthesize insights obtained from an internal analysis of the company's strengths and weaknesses with those of the analysis of external opportunities and threats. So you'll see in this picture here is you'll basically come up with things that are helpful, things that are harmful, things that are internal, things that are external, and you'll have the 4 categories of strengths, weaknesses, opportunities, and threats. And the last one I'll show you is sort of based on intangible assets model. It shows how different companies are at different stages of evolution. The most simplest companies look at themselves as their technology is their product. The product itself is the asset of the company, as opposed to one level up, which might mean that there's a product clusters or projects that could be built around customers. As you progress from mentalities of customer retention to customer satisfaction, and ultimately with the end of wanting to achieve customer success. So whereas the project as the asset trying to get different products to work together for a client, the next level 3, would be the enterprise as a whole as an asset. And you'll see the big companies like IBM Global Services, Google. You can come up with your versions of those where the entire enterprise can be organized around a customer's success. Ultimately, looking at level 4, where the customer becomes the asset and everything is geared around the customer, and then at the very end of that, the final level is having knowledge be your asset. And there are different aspects of areas of how a company would measure itself. For example, structure in a level 1 company is very hierarchical and functionally driven. In level 2, it becomes more matrix driven, which we talked about in our last section. Then as it gets more advanced, then you have to deal with more complex structural models like distributed coordination, communities of practice, even symbiotic networks. You can look at things like technology, which can go from very basic things like database orientation all the way up to looking at things like technology as a competitive weapon, or ultimately having your technology just be processing knowledge and accumulating knowledge. And that's where, because in that last level 5, knowledge is the asset. So technology would be, how do we keep increasing the amount of knowledge that we have? Even your people structures. So when you look at level 3, enterprise as the asset, and you start to get into more structured collaboration. When you get more towards the level 5, now you're looking at self-managed teams, knowledge workers, which all sort of correspond to this idea that knowledge is the ultimate asset. It's a very interesting model, less quantitative aspects to it, but it certainly is very descriptive of the evolution of different companies. I would say it's less proscriptive but more descriptive of and you can think about, just off the top of your head, different companies that you're aware of and where they might fall on this continuum of this assets model. I'm going to stop here. We'll cover more of this when we're together in our meetings. I really thank you for your time and attention on this.